Imagine you log into your online banking portal one morning and you see a massive unexpected withdrawal. The money is just gone.
Yeah, that's a heart-stopping moment for anyone.
Right. Naturally, you click on the transaction details to see exactly where your funds went. But instead of the name of a store or, a utility company, the bank statement simply says Earth.
I mean, it's technically true, assuming the money didn't literally leave the planet. But it's entirely useless for understanding your actual financial reality.
Exactly. It provides zero actionable information. It's a geographical fact that actively obscures the truth.
And that kind of obfuscation happens in corporate finance more often than you'd think.
Oh, absolutely. If you look closely at the financial statements of a massive publicly listed company, you generally assume the hard math is the only thing you need to worry about. You assume the numbers tell the whole story.
Right, but today we're doing a deep dive into a case where the math was entirely derailed. The financial reality was completely obscured by a single, seemingly innocuous word.
And that word is retirement.
Yeah. It's a word that looks perfectly innocent sitting there on a glossy annual report. To a layperson, it sounds like responsible corporate management.
Like, oh, they're just retiring an old asset, making room for the new.
Exactly. But in the rigid, rule-bound universe of accounting, applying that specific word in that specific way legally violates two entirely separate foundational Indian accounting standards.
Well, welcome to a new episode on the JAP Advisors Ind AS Clinic podcast. Whether you're an auditor meticulously documenting your working papers, a CFO finalizing your quarterly reports, or an investor trying to figure out if the company you're buying is actually as profitable as they claim, you are in the right place.
We're taking a deep dive into the architecture of financial reporting today. We're looking at how subtle grammar choices can completely manipulate a company's balance sheet.
Because the linguistic mechanics of financial reporting are often overlooked, aren't they?
They really are. I mean, we spend so much time running the calculations that we forget those calculations are governed by sentences. And when those sentences are structurally flawed, the resulting numbers are basically just fiction.
So let's lay out the source material for this deep dive. The foundation of our discussion today comes from an incredible observation featured in the 217th edition of the GAAP Advisors Task Weekly newsletter.
Which is an amazing resource, by the way.
It really is. It's authored by C.A. Manish C. Iyer, the director at GAAP Advisors, and it's published on LinkedIn. If you haven't seen it, there are over 230 editions published to date.
Yeah, it's required reading for anyone dealing with Ind AS, so definitely go subscribe to that newsletter on LinkedIn for free if you haven't already.
Definitely. And it's a vital resource because it doesn't just deal in abstract theory. The observation we're dissecting today was pulled directly from the published Ind AS financial statements of an actual listed company.
Right, real-world stakes here. And what's fascinating is how this was discovered.
Yeah, let's talk about that. These statements were downloaded and independently reviewed by GAAP Advisors on a suo motu basis.
Meaning nobody raised a red flag.
Exactly. Nobody tipped them off. GAAP Advisors simply pulled the public documents, applied their expert technical lens, and found a massive regulatory violation hidden in plain sight. Right there in the accounting policies.
Which is why, before we get into the actual text of the violation, we need to establish the specific parameters of the financial statements we're reviewing, just so you, the listener, have the baseline for this company's reporting environment.
Okay, let's set the ground rules.
So, the functional currency and presentation currency used in these statements is the Indian rupee.
Right.
And foreign currency is defined as any currency that is not the functional currency. Also, the reporting period we're looking at begins on the 1st of April and ends on the 31st of March.
Got it. Standard parameters for an Indian corporate entity.
And as always, we must state that the views expressed in this deep dive are the personal views of the author and are not binding on the audience.
A necessary disclaimer.
Absolutely. We strongly request that you seek the help of a qualified expert before taking any action or refraining from any action based on the views we are discussing today.
Okay, the guardrails are up. Let's get right into the text. We have a single paragraph from this listed company's accounting policy regarding their property, plant, and equipment, which we'll refer to as PPE.
Let's look at exactly how they constructed this policy.
I'll read the excerpt directly from their annual report. It says, an item of PPE is derecognized upon disposal, or when no future economic benefits are expected to arise from the continued use of the asset. Any gain or loss arising on the disposal or retirement of an item of PPE is determined as the difference between the net sales proceeds and the carrying amount of the asset, and is recognized in the statement of profit and loss.
Okay, so just pausing there.
Yeah, because if I'm a junior analyst skimming this report, My eyes are probably glazing right over this.
Oh, completely. It sounds incredibly professional.
Right. It sounds like standard, copy-pasted accounting boilerplate. It sounds authoritative. So, what is the very first crack in the facade here? Where is the trapdoor?
Well, the trapdoor is built on a very subtle conflation of two entirely different corporate events. The company has casually equated the concept of disposal with the concept of retirement.
They're treating them as the same thing.
Exactly. They are treating them as interchangeable triggers for the exact same accounting treatment. That is the first fundamental error regarding the physical asset itself.
And the second error.
The second error, which we'll get to a bit later, is in the final phrase, where they fail to specify the exact geography of where this financial impact is reported. They opt instead for a term that actively obscures the truth.
So we basically have an error of state, meaning what is actually happening to the physical asset, and an error of geography, where the resulting numbers are being hidden on the page.
That's a great way to summarize it. Let's make the error of state first, because this gets to the very core of Ind AS 16.
Which is the standard governing property, plant, and equipment.
Right. To understand the severity of what the company wrote, we have to look at the strict rules of Ind AS 16, specifically paragraphs 67 and 68. Paragraph 67 is the ultimate gatekeeper for what we call derecognition.
Derecognition, meaning the moment an asset is officially wiped off the company's balance sheet.
Yes, exactly.
It's basically the accounting equivalent of declaring the asset legally dead or entirely gone from the company's possession.
Precisely. And because derecognition has such a massive impact on a company's total asset value, Ind AS 16 does not allow management to just casually decide when to wipe something off the books.
They can't just wake up and say, let's get rid of this.
No, they can't. Paragraph 67 provides only two highly specific scenarios where an item of PPE can be derecognized.
Okay, what's the first one?
The first is very straightforward. Upon disposal.
Meaning you sold it, you traded it in, maybe you gave it away. The asset physically left your control and your ownership.
Yes. The title transferred. Now, the second scenario is slightly more nuanced. An asset is derecognized when no future economic benefits are expected from its use or its disposal.
Ah, okay. So in that second scenario, the physical asset might still be sitting on the factory floor, but it is utterly and completely worthless.
Right.
It's a machine that's broken beyond repair, produces absolutely nothing, and nobody would even buy it for scrap metal. It has a functional and residual value of absolute zero.
Correct. If it cannot generate cash flows through operations, and it cannot generate cash flows through a sale, its economic life is officially over. And in that case, it must be derecognized.
Okay, so those are the only two doors you could walk through to get an asset off the balance sheet.
Those are the only two doors. And the trap here is paragraph 68. Because that paragraph strictly gates when you can actually claim a financial gain or a loss, tying it directly to that derecognition event.
I see.
Paragraph 68 states that the gain or loss arising from the derecognition of an item of PPE shall be included in profit or loss when the item is derecognized.
Got it. So the entire calculation of a gain or loss is predicated on the asset successfully and legally passing through one of those two doors in paragraph 67.
Exactly. You can't claim a loss if you haven't derecognized it properly.
Okay, let's bring this back to the company's policy. The company states, any gain or loss arising on the disposal or retirement.
Yes, notice that word.
They are actively claiming that retirement triggers a gain or a loss. But based on what you just said, the word retirement does not appear in paragraph 67.
It doesn't appear at all, and that absence is not a typo by the standard setters. It is a deliberate philosophical boundary.
Wow, really?
Yes, an item of PPE is not derecognized simply upon retirement from active use. Therefore, you absolutely cannot mathematically or legally calculate and record a gain or loss on the mere retirement of an asset.
Let's ground this in a physical reality, because retirement is a term business leaders use all the time, right?
They do, constantly.
So, say a logistics company has a heavy-duty delivery truck. If they sell that truck to a local farmer, that is a disposal. The title transfers, the truck leaves the property, derecognition occurs.
That's a perfect example of door number one.
But let's say they just buy a new fleet of electric trucks. So they take the keys out of the old diesel truck and park it in the back lot of the warehouse. They retire it from the daily road. That old truck hasn't been disposed of. It's still sitting on their asphalt.
And crucially, it still possesses potential future economic benefit. Even if they never drive it again, they could theoretically sell it for spare parts next year. They could sell it for scrap.
Right.
Because that potential economic benefit still exists, it completely fails the test of the second scenario in paragraph 67. It is not economically dead.
So, by writing this policy, the company is effectively saying, whenever we park a truck in the back lot, we are going to pretend it doesn't exist anymore, wipe it off our balance sheet, and record a financial loss in our profit and loss statement.
Which is an egregious violation of Ind AS 16. It's pure fiction. But, the distortion doesn't stop there.
It gets worse.
Oh, it gets much worse. To really understand the systemic damage of this policy, we have to look at the secondary mechanism that this retirement trick breaks, and that is depreciation.
Right, because if an asset is technically still sitting on your balance sheet, it is subject to the rules of wear and tear, obsolescence, and time. Which brings us to paragraph 55 of Ind AS 16.
Yes. Paragraph 55 is the engine of depreciation. It dictates the timeline. It states that depreciation of an asset begins when it is available for use, when it's in the location and condition necessary for it to operate.
Okay, that makes sense.
But more importantly for our specific case, it dictates exactly when depreciation stops.
And I'm guessing when management parks it in the back lot is not one of the approved stopping points.
Far from it. Paragraph 55 states that depreciation of an asset ceases at the earlier of two highly specific dates. The first is the date the asset is officially classified as held for sale in accordance with Ind AS 105.
Let's unpack that for a second, because companies might try to argue, well, we retired the truck because we plan to sell it eventually. Why doesn't that vague intention just trigger the held for sale clause and let them stop depreciating it?
Because Ind AS 105 is not about vague intentions. Classifying an asset as held for sale requires meeting incredibly strict criteria.
Like what?
Well, management must be committed to a formal plan to sell the asset. There must be an active program to locate a buyer. The asset must be actively marketed at a price that is reasonable compared to its current fair value. And the sale must be highly probable within 1 year.
Oh, wow. So it's a very high bar.
Very high. You cannot just park a truck, leave it to rust, vaguely hope someone buys it someday, and call it held for sale.
Okay, so if you don't meet that rigorous standard for Ind AS 105, what is the second date that allows you to stop the depreciation clock?
The date the asset is derecognized under paragraph 67, which, as we've already established, only happens on actual disposal or when it reaches absolute zero economic value.
And here is the punchline from paragraph 55 that completely destroys this company's accounting policy, right?
Yes. Paragraph 55 explicitly concludes, therefore, depreciation does not cease when the asset becomes idle or is retired from active use unless the asset is fully depreciated.
That is the smoking gun right there. Even if the asset is completely idle, gathering dust, not producing a single unit of inventory for the company, the depreciation clock is still ticking.
Exactly. The company is legally required to continue recording a depreciation expense for that asset every single year.
Why are the standard setters so strict about this?
The accounting boards instituted this for a very specific reason. The matching principle. Assets lose value not just through physical wear and tear, but through time and obsolescence.
Like a computer losing value just because newer models come out.
Precisely. If you own an idle machine, the economic cost of holding that depreciating machine is a real, tangible expense. If you stop recording depreciation just because you aren't using it, you are lying to your investors about the ongoing cost of your capital infrastructure.
So let's look at the compound mechanism of this company's error. Let's walk through what this actually looks like on a multi-year timeline.
Let's do it.
Say it's year one, and they decide to retire a massive piece of factory equipment. Under their flawed policy, what happens?
First, they bypass paragraph 55 entirely. They illegally stop the depreciation clock, which means they are no longer recording the required expense for holding that idle asset.
Okay.
Second, they bypass paragraph 67. They treat the retirement as a disposal, falsely derecognizing the asset and ripping it entirely off their balance sheet.
Shrinking their total asset base artificially.
Exactly. And third, because they falsely derecognized it, they take the remaining carrying amount of that asset and dump it into their profit and loss statement as a recognized loss.
Wow. So in year one, their balance sheet looks smaller, and their net profit takes a massive artificial hit because of this fake loss.
Yes.
But what happens in year two and year three?
That's where the manipulation really pays off for them. In year 2 and year 3, that asset is still sitting on their property, slowly losing value. Under Ind AS 16, they should be recording a steady depreciation expense each year, lowering their profit.
Right, because of the matching principle.
But because they illegally derecognized it back in year 1, that annual expense is gone. It vanished.
Wait, so Their expenses in year 2 and year 3 are artificially low.
Yes, which means their net profits in those future years will look artificially high.
Oh, it's an accounting time machine. They pull all the future expense into a single fabricated loss in year 1, taking a big bath, as they call it, so that their future earnings look incredibly robust and highly profitable.
You nailed it. It completely skews the financial trajectory of the company, and it definitively proves absolute noncompliance with Ind AS 16, all orchestrated by simply swapping the word disposal with the word retirement.
It is a profound example of how accounting policies are not just administrative paperwork. They are the actual code that runs the financial machinery of the company.
And if the code is corrupt, the output is corrupt.
Okay, we've totally dismantled the first half of the paragraph. We've proven that the state of the asset was entirely misrepresented. But now we need to look at the final sentence of their policy.
The geography error.
Right, we need to pivot to the geography of the financial statement. Because even when they engineered this fake loss, they didn't just put it anywhere, they hid it.
They did.
This brings us to the second massive violation, the Ind AS 1 violation, which deals with the presentation of financial statements.
Let's read the very end of their policy statement again. They claim this gain or loss is, quote, recognized in the statement of profit and loss.
Now, at first glance, that sounds perfectly reasonable to me. I mean, we just discussed how paragraph 68 of Ind AS 16 says gains or losses from derecognition go into profit or loss.
Right.
So when the company says they put it in the statement of profit and loss, aren't they just agreeing with you? Aren't they just following instructions? Aren't we just splitting hairs here?
It sounds compliant until you understand the strict architectural rules of Ind AS 1, specifically paragraph 10A.
Okay, what does paragraph 10A say?
And AS 1 doesn't just dictate what numbers you report. It dictates the exact physical layout of the pages you report them on. Paragraph 10A states, an entity shall present a single statement of profit and loss, with profit or loss and other comprehensive income presented in 2 sections.
2 distinct sections.
Yes, the paragraph continues. The sections shall be presented together, with the profit or loss section presented first, followed directly by the other comprehensive income section.
This is a crucial distinction that a lot of casual readers miss when they look at annual reports. The overarching document is titled the Statement of Profit and Loss. But within that document, there is a hard boundary line.
Very hard.
You have the top section, which is traditional profit or loss. This is your core operational engine: revenue, cost of goods sold, administrative expenses.
Correct. That top section tells you how the actual business is performing day to day.
And then below that, you have the second section, other comprehensive income, or OCI.
Yes.
This is where you park the non-operational financial impacts.
Right.
Unrealized gains on certain investments, foreign currency translation adjustments, actuarial gains on pension plans, things that affect the company's net worth but aren't generated by selling their core product.
Exactly. The statement of profit and loss comprises 2 entirely different neighborhoods. When the company's policy simply states that the amount is recognized in the statement of profit and loss, they are only naming the city.
I see.
They have completely failed to identify which of the 2 sections the financial impact is actually residing in.
It's exactly the equivalent of your bank statement just saying Earth. Geographically true, but analytically useless.
Exactly.
If I'm an investor calculating EBITDA earnings before interest, taxes, depreciation, and amortization, I need to know if this massive loss is sitting in the core operational section or hiding down in the OCI section. By omitting the word section, the company forces the reader to guess.
And under Ind AS 1, making the reader guess is not just poor formatting. It is a fundamental breach of transparency.
Really? The standard explicitly calls that out.
It does. To understand how severely the standard views this, we have to look at paragraph 7 of Ind AS 1. This paragraph formally introduces and penalizes the concept of obscuring information.
It's fascinating that the accounting standards actually codified the concept of obscurity. It acknowledges that companies don't always lie by making up fake numbers. Sometimes they lie by wrapping the real numbers in a thick layer of fog.
That is exactly the intent of paragraph 7. It states, in no uncertain terms, that communicating information in a way that obscures it has the exact same effect on the primary users of financial statements as omitting the information entirely or misstating it completely.
That is a very powerful equating. The standard says that being vague is legally and functionally identical to outright lying.
It is. If you hand an investor a puzzle instead of a clear disclosure, you have failed the standard.
So how does the standard define this fog?
Well, paragraph 7 doesn't just leave obscuring up to interpretation. It actually provides 5 highly specific examples of circumstances that result in material information being obscured.
Oh, that's incredibly helpful.
It is essentially a catalog of the most common corporate reporting tricks. And analyzing them really sheds light on the psychology of financial manipulation.
Let's weave through these 5 examples because they perfectly illustrate how companies try to hide the ball. What is example A?
Example A states that information is obscured when it is disclosed in the financial statements, but the language used is vague or unclear.
Well, this is the exact territory our company's policy falls into. By using the broad title of the statement without specifying the distinct section, the language becomes geographically vague, rendering the disclosure unclear.
Absolutely right.
It makes me think of example B, too, which is when information regarding material item is scattered throughout the financial statements. This is the classic Easter egg hunt strategy, isn't it?
Exactly. A company might put the top-line revenue number in the management discussion analysis on page 10, bury the associated deferred revenue liabilities deep in a footnote on page 45, and put the tax implications in a supplementary schedule on page 90.
And then they throw their hands up and say, what? We disclosed everything. It's all in the document.
Yeah, they technically can claim that.
Yeah.
But Ind AS 1 views that fragmentation as an active obscuration because no reasonable user could synthesize it accurately without a team of analysts.
Which naturally leads to example C, where companies hide things not by scattering them, but by inappropriately aggregating dissimilar items.
Yes, combining things that have completely different risk profiles or economic realities.
Can you give an example of that?
Sure, imagine a massive grocery conglomerate reporting its physical inventory. If they group perishable produce and long-term canning equipment into a single massive line item simply labeled assets, they are inappropriately aggregating dissimilar items.
Oh, wow. Yeah, because an investor has absolutely no idea how much of that value is rotting on the shelves next week versus how much will last for 10 years.
Precisely. The underlying economic reality is completely destroyed by the aggregation.
And example D is the inverse of that, right?
Yeah.
When similar items are inappropriately disaggregated, this is when a company tries to hide a forest by making you look at 1,000 individual trees.
That's a perfect analogy. Suppose a bank has a massive systemic problem with bad loans across its entire commercial real estate portfolio.
Okay.
If they report that bad debt as 50 separate, individually immaterial line items broken down by specific city zip codes, instead of presenting one aggregate commercial real estate bad debt number, they are actively obscuring the sheer scale of the systemic failure.
They're overwhelming the user with fragmented data to hide the macro trend.
Exactly. Which ties perfectly into the final tactic, example E. This occurs when the understandability of the financial statements is reduced because material information is hidden by immaterial information.
Ah, the needle in the haystack approach.
Yes, burying the lead. A company might have a critical multi-million-dollar pending lawsuit that threatens their very existence. But instead of presenting it clearly, they sandwich the disclosure between 20 pages of dense boilerplate text about their routine office supplies procurement policy.
And their corporate recycling initiatives, right?
Exactly. They drown the primary user in so much irrelevant garbage that the user is unable to determine what information actually matters.
It's just weaponized formatting.
It really is.
But bringing it back to our specific listed company and their single paragraph on PPE, they didn't even need 20 pages of boilerplate. They achieved obscuration in just a few words.
They did. As we established, their disclosure falls perfectly under example A. By failing to specify whether the gain or loss on their supposedly retired asset went to the profit or loss section or the other comprehensive income section, they used vague and unclear language regarding a material item.
Therefore, they presented obscuring information, definitively violating Ind AS 1.
Exactly.
So if we step back and look at the total carnage caused by this one mundane-sounding paragraph. First, they invented a trigger scenario retirement that legally does not exist for derecognition under Ind AS 16.
Right?
Second, because they falsely claimed retirement equals disposal, they illegally stopped depreciating the asset, violating the matching principle and artificially reducing their future expenses.
Correct.
Third, they illegally ripped the asset off their balance sheet, shrinking their asset base. Fourth, they manufactured a completely fake financial loss. And finally, they hid where that fake loss was recorded by using geographically vague language, legally committing the act of obscuring information under Ind AS 1.
It is a breathtaking cascade of noncompliance. And what's truly concerning is that to the untrained eye, the paragraph reads like standard professional accounting policy. It doesn't look like fraud. It looks like administrative routine.
Which brings us to the most vital part of this deep dive.
Yeah.
The real-world stakes. Having forensically dismantled this paragraph, we need to understand why this level of scrutiny is critical.
Because it affects real people and real money.
Exactly. Let's talk about the retail investor. Say I'm sitting at home looking at my stock portfolio, considering buying shares in this specific listed company. I don't have GAAP advisors looking over my shoulder. How does this highly technical accounting failure actually impact my real money?
It completely distorts the fundamental metrics you use to make your investment decisions. If you happen to invest in listed company shares, you rely heavily on indicators like earnings per share, return on assets, and overall profit margins.
Right, the exact numbers that pop up in big green or red text on my trading app.
Exactly. Now, trace the impact of this company's error. In the year they execute this retirement policy, they recognize a massive fabricated loss. This artificially depresses their net profit for that period.
Okay, so if I'm an investor looking at those financials, I might think, wow, the company's earnings are tanking, management is failing, I need to sell my stock immediately.
Yes. You might exit a solid position at a loss entirely based on a mathematical fiction.
And it gets worse in the subsequent years, doesn't it?
Oh, significantly worse. Because they illegally removed that asset from their books, they are no longer recording the depreciation expense they legally owe. Their expenses in year 2 and year 3 are artificially low.
So next year, I might look at the stock and see a massive, inexplicable jump in profit margins. I might think, wow, the company turned it around. I should buy in heavy.
Right, but there is no real operational boom. It's just an illusion created by the absence of a required expense.
That is the danger. You are buying and selling based on an engineered narrative,
Yeah.
not economic reality.
This is exactly why a detailed review of a company's financial statements for strict Ind AS compliance is not just an academic exercise for accountants, it is an absolute necessity.
It's protective.
Exactly. Catching these artificially recognized losses or obscured incomes is the only way investors can make proper informed decisions on buying, holding, or selling shares.
This is exactly why we need to talk about preventative measures. The fact that GAAP advisors found this observation from published Ind AS financial statements of a listed company, downloaded and independently reviewed on a suo motu basis, it means this company's executive team, their internal audit committee, and their statutory auditors all signed off on this entirely flawed policy.
And they published it to the world.
If there is a CFO, a finance director, or a corporate controller listening to this right now, you cannot afford to have this happen to your company.
The reputational and financial damage of a restatement when the regulators force you to go back and correct these errors publicly is immense. It destroys market trust instantly.
Which is why you must get your financial statements reviewed by GAAP advisors before you sign them, before you finalize the PDF and upload it for the public markets.
It's the smart move.
Have the independent experts apply this exact forensic lens to your policies so you don't become the subject of a regulatory crackdown, or worse, our next deep dive. The process is remarkably simple. You can submit your financial statements in near-to-publishing PDF format by email to info@gapadvisors.com.
Right.
Again, that is info@gapadvisors.com. Let the experts stress test the structural integrity of your reporting.
It is an essential step in modern corporate governance, but, it's also important to acknowledge the immense pressure placed on the people actively trying to catch these errors, the statutory auditors.
Oh, let's definitely talk about the auditors.
Yeah.
Because their job sounds nearly impossible in this context. You have teams of auditors staring at hundreds of pages of these policies day in and day out.
It's exhausting work.
And as we just proved, the difference between a clean audit opinion and a catastrophic failure of standard can come down to swapping the word disposal for retirement. The sheer cognitive load of cross-referencing every single sentence against the entirety of Ind AS is staggering.
It is an incredibly difficult, high-stakes environment. Auditors aren't just looking for misplaced decimal points anymore. They have to be forensic linguists. And when they do spot an anomaly, the battle is only half won.
Because if an auditor flags this paragraph, the company's management might push back. The CFO might say, look, everyone uses the word retirement. It's industry standard. You're being too pedantic.
Exactly. The auditor can't just say, I have a gut feeling it's wrong. They need ammunition.
They legally need to document exactly how they addressed and resolved any issue regarding the application of Ind AS in their audit working papers. They need to cite the specific paragraphs, interpret the standard correctly, and provide a technically bulletproof rationale.
Which is exactly why the issue repository created by Gap Advisors is such an unprecedented lifeline for the audit community.
The issue repository is an absolute game changer. Let's make sure everyone knows how to access this. If you go to https.gapadvisors.com, you will find a repository that currently hosts over 4,500 issues and their detailed responses on Ind AS and Indian GAAP.
Think about the scale of that. Over 4,500 highly specific, complex accounting scenarios that have been thoroughly analyzed, resolved, and documented.
It is essentially an encyclopedia of applied accounting logic.
And it is completely accessible. Any person can register for free on the website.
Once you register, you aren't just getting access to a static library. You can submit issues on Ind AS and Indian GAAP. So if you are an auditor sitting at a client site at 11:00 p.m. arguing over the definition of derecognition, you can submit the issue.
And then what happens?
A detailed response is delivered directly to the inbox of the email you registered with at https.gapadvisors.com, which is extremely helpful, particularly for an auditor who needs to document how they addressed any issue on the application of Ind AS.
It provides the robust technical backing that an auditor needs to stand their ground. It transforms a subjective argument over language into an objective, documented application of the standard.
It's an unbelievable resource. If you're an auditor, an analyst, or a finance student, you need to go to https.gapadvisors.com and register immediately.
I couldn't agree more.
Well, as we bring this extensive forensic deep dive to a close, it's clear that the foundation of financial reporting requires constant, vigilant inspection. We started by questioning the architectural blueprints of the financial world, and we've seen firsthand how a single misplaced brick can threaten the entire structure.
And as we conclude, I want to leave you, the listener, with a final, somewhat provocative thought to consider.
I love these. Let's hear it.
Think about the sheer psychology underlying global financial disclosures. We inherently trust the numbers, we build algorithms to trade on them, we base our retirements on them, we judge the health of our economies by them.
We treat them as absolute truth.
We do. But if a massive publicly listed company can completely obscure its financial reality, unofficially distort its profitability timeline, and violate two major accounting frameworks simply by casually swapping the word disposal for retirement and omitting the word section, how much of our global financial landscape is actually shaped by hard objective math?
Well,
And how much of it is shaped by the subtle, highly subjective grammar constructed around those numbers? Is absolute financial transparency truly achievable, or are we constantly navigating an illusion maintained by increasingly complex language?
that is a brilliant and slightly terrifying question. Are we investing in mathematics, or are we just investing in incredibly well-crafted sentences? That fundamentally shifts how you look at the market.
It really does.
Listen, if this deep dive sparked a realization for you today, or if you found yourself furiously taking notes, we need your help to spread this knowledge. Please share the podcast among your contacts, colleagues, audit, and finance teams.
And the students, too.
Well, especially the students. Please share this with students pursuing their CA course to spread the knowledge of Indian accounting standards. They are the future architects of our corporate environment, and they need this vital knowledge to ensure the structural integrity of tomorrow's markets.
The earlier they learn to identify the flaws in the language, the stronger our financial foundations will be.
Absolutely. From both of us, we want to sincerely thank you for your time spent listening today. We know how dense this material can be, and we deeply appreciate you spending your time navigating the complexities with us.
It's been a great discussion.
Finally, we request you to follow or subscribe to Gap Advisors Ind AS Clinic Podcasts on Spotify, Amazon Music, and YouTube, whichever platform you prefer to listen to Gap Advisors Ind AS Clinic Podcasts on. Make sure your notifications are on so you never miss a deep dive.
Until next time, trust the math, but always, always verify the grammar.
We'll see you on the next episode.